Let's talk about Tesla. The stock is either poised to become the next $3 trillion giant or it's heading for the next big crash. By 2026, a lot of investors are going to find themselves on the wrong side of that bet. So in the next few minutes, we're going to give you a clear framework to help figure out which side you should be on. Okay, let's just cut right to the chase. Here's the one question that really matters. If you buy Tesla stock today, are you going to look back in 2026 and seriously regret it? That's the core issue we're going to unpack right now. To even begin to answer that, you have to realize that Tesla is standing at a massive fork in the road. And before we can figure out where it's going, we've got to get a crystal clear picture of where it is right now. So what's so interesting about this snapshot is just how many mixed signals there are. I mean, on one side, the main car business is definitely showing some cracks. We're talking about the first ever yearly drop in deliveries, and then another one right after. And the competition, it is getting absolutely brutal. But then you look at the other side, and its energy division has somehow become the most profitable part of the entire company. And even with all these headwinds, the stock is still trading at a ridiculously high valuation. The whole thing is just full of tension. Okay, so you look at that complicated picture, and you're probably thinking, why on earth would anyone be bullish on this? Well, it's because they're not really investing in the company we just described. They're investing in the vision for 2026. Let's explore that first path, the road to becoming a $3 trillion giant.
See, the bull case really has very little to do with selling more cars. It's about a complete and total transformation. It's about a future with a massive fleet of self-driving robotaxis, which, by the way, are already being tested without drivers. It's about Optimus, the humanoid robot that's already in pilot production, and some people think that business alone could be bigger than the car business. And you can't forget the energy division, where storage deployments have been growing at a staggering 180% compounded rate. The bulls don't see a car company, they see an AI and robotics company, plain and simple.
So how in the world do you get from that vision to a number like $3 trillion? Well, it all boils down to this one core idea in finance called discounted cash flow, or DCF. The concept is actually pretty simple. Any company is basically worth the sum of all the cash it's ever going to make in the future, just adjusted for what that cash is worth today. The bulls look at things like robotaxis and Optimus, and they see future cash flows that are just astronomical. And this right here, this is the engine that turns that big story into a hard number. This formula is how you do it. The bulls, they plug in these gigantic future cash flow numbers from all those new projects, they run it through this exact engine, and what pops out the other side is a valuation that makes today's stock price look like a bargain. Now, that's a seriously powerful and exciting vision. But what if it's just that? A vision, a story. Let's walk down the other path at that fork in the road and see how this whole thing could go spectacularly wrong. This is path number 2, the big crash. The bear case is all about today's reality. A slowdown in demand for EVs, a car lineup that's getting a little old, and constant price cuts that are eating into profits. And of course, the competition is just relentless. But the biggest point for the bears is execution risk. Let's be honest, Tesla has a long history of promising revolutionary stuff on timelines that turn out to be, well, let's just call them optimistic. And let's be really clear about that competition. This isn't some problem for the distant future. Just look at this side by side with BYD. While Tesla's cutting prices just to keep sales up, BYD has already blown past them to become the leader in the global EV market. The ground is literally shifting under Tesla's feet as we speak. Hey, remember that DCF valuation engine, the one the bulls love? Well, the bears use the exact same formula. They just focus on a different part of it, the discount rate. See, that rate is supposed to measure risk. So the bears, they look at the competition, the missed deadlines, the shrinking profit margins, and they say the risk here is incredibly high. And when you crank up that discount rate, all those dreamy future cash flows become worth a whole lot less today. So you've got the bulls' dream on one side, the bears' reality check on the other, and they're both using the same financial logic to come to wildly different places. So how are the professionals, the analysts on Wall Street, handling these two completely different stories? Let's take a look. Wow, I mean, this chart really says it all, doesn't it? The disagreement here is just staggering. You've got the bear targets way down here, predicting a huge crash from where we are today. Then you've got the bull targets way up here, pointing toward that multi-trillion-dollar dream. And the average,
It's just kind of stuck in the middle, which basically screams uncertainty. The market has absolutely no idea what Tesla is or what it's going to be. You know, this whole situation reminds me of a great quote from the valuation expert Professor Aswath Damodaran. He says, "There's danger when analysts agree too much, but there's also danger when they agree too little. Because when the predictions are this spread out, it basically means the information everyone's working with is so speculative, so noisy, that it might as well be useless." Okay, so if the experts are this divided, how on earth are you supposed to make a decision? Well, I think the key is to stop trying to predict the future and start trying to understand what kind of investor you are. And that's exactly what we're going to cover in this last section, a simple decision framework.
Look, it really boils down to two main types of people. Are you a high-risk, long-term investor who's willing to make a big bet on a vision, or are you a more conservative investor who cares more about stability and proven results? So let's talk about that first profile. If you hear words like robotaxi and Optimus and you get genuinely excited, and if you have a long time to invest and you can handle some insane price swings, then you're basically speaking the same language as the bulls. For this type of investor, buying Tesla today is a bet that that huge transformative vision is actually going to happen.
But on the other hand, if you're the kind of person who's really focused on the current EV slowdown, you're worried about competitors like BYD, and you just can't get over how high that valuation is for the risks involved, then the bear case is basically a giant warning sign for you. For a more conservative investor, owning Tesla stock directly might be just too much of a gamble. A diversified fund like an ETF that happens to hold some Tesla might be a much smarter way to go.
So, there you have it. Two completely different paths for Tesla as we head toward 2026. One leads to a $3 trillion company built on a future of AI and robots. The other leads to a crash based on the tough realities of the car market today. We've given you the framework. So the final question is all yours. Which path will you be on?